What if I told you that trying to beat the market might actually be the biggest mistake you could make with your money? It's a seductive idea, right? Finding that one stock, that secret insight, the perfect timing to buy low and sell high. That's the promise of active investing. It's the strategy where a fund manager, or you, is constantly picking individual stocks, forecasting market trends, and making frequent trades, all to outperform a market benchmark like the S&P 500. But here's the reality check. Backed by decades of data, the vast majority of active fund managers fail to beat the market over the long term, especially once you account for their higher fees. Enter passive investing. It's simple, boring, and, statistically speaking, a much smarter bet for most people. Passive investing doesn't try to beat the market, it aims to own the market and simply track its performance. This is typically done through low-cost exchange-traded funds, or ETFs, that follow a broad index. When you invest in a passive index fund, you immediately get exposure to hundreds or even thousands of companies, offering instant, powerful diversification. If one company dips, it's just a tiny fraction of your portfolio. Now, why does a company like Wealthsimple lean so heavily into this passive approach for our managed portfolios? It comes down to three key factors: fees, performance, and simplicity. First, fees. Active investing means paying for those highly paid portfolio managers, their analysts, and the frequent trading commissions. Those costs add up, often charging 1% or even 2% annually. Now, 1% might not sound like much, but over 30 years of investing, high fees can literally eat up tens of thousands of dollars in potential returns. Passive ETFs, by contrast, are automated and require very little management, leading to ultra-low fees, often just a fraction of a percent. Second, long-term performance. Since most active managers struggle to consistently outperform their passive counterparts after factoring in those high fees, a low-cost, diversified passive portfolio is historically the superior strategy for long-term growth. We believe in the efficiency of the overall market, and by minimizing costs, we maximize the money that actually stays in your pocket and keeps growing. And finally, simplicity. Passive investing is set it and forget it. We handle the hard stuff for you, like automatic rebalancing and dividend reinvesting, so your portfolio stays perfectly aligned with your goals and risk tolerance, without you having to constantly obsess over market headlines. It removes the two biggest enemies of a successful investor, emotion and cost. By favoring passive investing, we put the odds, and the savings, firmly back on your side. With that said, thanks for watching, and until next time.